Good afternoon, everyone. Welcome to the Economic Forum's Technical Advisory Committee on Future State Revenue. As many of you are aware, the immediately preceding chair has retired, and so as vice chair of the preceding Technical Advisory Committee, I will be presiding over the committee for a portion of the meeting up through agenda item 3, where a new committee chair will be selected. And with that, Mr. Ginden, would you please call the roll?
Thank you, Madam Acting Chair. For the record, Russell Ginden with the Fiscal Analysis Division, Legislative Counsel Bureau. And just since there's no perception of preference, I'm just going to call on the roll that are listed in statute. So Wayne Thorley.
Here.
Sarah Kaufman.
Here.
Amy Stephenson.
Here.
David Schmidt.
Here.
Andrew Klinger.
Here.
Matt Lawton.
Here.
Mary Walker as the designee for Marvin Levitt, who is the chair of the local government finance. That's the statutory position.
Here.
So, Madam Chair, Acting Chair, let the record show that all members are in attendance, with Andrew Klinger attending virtually through the Zoom link.
Thank you, Mr. Ginden. The next item on our agenda is public comment. Public testimony under this agenda item can be made either in person, by phone, or in writing. Because of time constraints, each person offering testimony during this period of public comment will be limited to not more than 3 minutes. There are instructions on the agenda for calling in as well as emailing written testimony. So with that, is there any public comment in Carson City? Okay, seeing none, is there any public comment on the phone lines?
Thank you, Chair. If you would like to make public comment on today's meeting, please press star 9 now to take your place in the queue. Thank you, Chair. It appears there are no callers wishing to make public comment at this time.
Okay, thank you very much. Moving on to agenda item number 3, election of chair and vice chair. Is there anyone who would like to nominate a member of the Technical Advisory Committee for chairmanship?
Madam Chair, or Madam Acting Chair, I would nominate David Schmidt as chair of the TAC.
Okay, thank you. Do I have a second?
I'll second.
Okay, is there any discussion on the motion? Hearing none, all those in favor say aye.
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 Anyone opposed? Motion carries. I will go ahead and hand the gavel over to Chairman Schmidt.
All right, thank you. I believe the next item that we have is the election of a vice chair. Is there someone that would like to make a motion to elect a vice chair?
Mr. Chair, I would nominate Amy Stevenson as vice chair of the TAC and make that in the form of a motion.
A second?
I would second that.
Okay, we have a motion from Mr. Thorley, a second from Ms. Kaufman. Any discussion? All in favor, please say aye.
Aye.
Any opposed? Okay, motion carries. Agenda item 4 is the approval of the April 28th, 2021 meeting minutes. Do we have a motion for that?
Mr. Chair, I would make a motion to accept the meeting minutes for the April 28, 2021 meeting.
Second?
I'll second it.
Okay, motion from Ms. Kaufman, second from Ms. Walker. Any discussion? Hearing none, all in favor, please say aye.
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 Any opposed? Motion passes. Next up on the agenda, we have the review and approval of revenue forecasts for selected general fund sources, including taxes, licenses, fees, fines, and other revenue for presentation to the Economic Forum at the Economic Forum's November 14th, 2022 meeting. Mr. Gindin, if you like, and with the pleasure of the committee, if we want to take agenda items 5 and 6 together, maybe just hear all of the numbers at first and then go forward with motions as appropriate.
Thank you, Chair Schmidt, and we will do that then in terms of going through the information that would be under agenda item 5, and then after addressing that in questions, we can move on to agenda item 6, which is the tax credits. Before doing that, Mr. Chair, I just want to put one piece of information on the record, which is the meeting materials for this meeting. If you're going to Nellis, which is the legislature's website for the information, this meeting is listed there, and you can click and view the meeting. But be able to get the supporting materials that you've been made available to you here and also are available for the public online, but also anybody that's listening and wants copies, that they can contact the GFO or office and they can get copies of the material. But the link is actually on the GFO's website, GFO, the Governor's Finance Office. And I'll keep saying GFO, and if I say fiscal, I mean the Fiscal Analysis Division, just to try and I'll put that up front. Because the staffing of this body, as well as the Economic Forum, is jointly shared by statute by staff from the Governor's Finance Office and staff from the Fiscal Analysis Division. And so because of that sharing, the GFO is principally more responsible for the TAC, and the Fiscal Division is principally more responsible for the Forum. So the material for today's meeting is available at budget.nv.gov/meetings/budget_division. And there you'll see the TAC listed as a meeting. And you can get the agenda there as well as the documents that we'll be discussing here for this meeting. And thank you, Mr. Chair, for allowing me to put that information on the record. And with that, I can proceed into agenda item 5.
Please.
Thank you, Mr. Chair. What you should have is 3 documents available to you this afternoon. And the first one is Table 1. And so that's just for your benefit, that it shows you all of the general fund revenue sources, but the Technical Advisory Committee is only responsible for what we call the minor general fund revenue sources. And so that shows you the last 3 years of actual collections. And then it shows you the year-to-date collections for FY 2022, the preceding fiscal year, and then the year-to-date for the current fiscal year, FY 2023. And so it's important to keep in mind when you're looking at the year-to-date stuff that for some of these revenue sources, they have a well-defined date in which the taxes or fee is due, and then it's required to be reported to the agency that administers that, and then it's actually reported in the controller's office. Other ones are dependent upon when the person may pay it to the agency, and then it gets posted in the system. So I just wanted to put that out there, that this early in a fiscal year, it can be somewhat tenuous to look for these smaller revenue sources and look at fiscal year 23 compared to FY 2022 year to date. And the thing to keep in mind for some of these, even though we're having this meeting here in early November, for some of the revenue sources, they may only show 2 months worth of collections because of the nature of the tax. So I just wanted to get that out there for this table, but it does allow you, and as we go through this, if there's questions, then staff may make reference to this table about where we're tracking year to date. When we do think it's a better apples to apples comparison, there is informational content in that statistic. And so then what you have is the table 3, which is the agency fiscal budget table is what we call it. And so what it does is it shows you the forecast for each of the 3 fiscal years that are in consideration here for this forecast cycle, which is FY23 as the current fiscal year, or what we sort of call the base year or current year forecast. And then the first year ahead forecast, FY24, and the second year ahead forecast, FY25, thus for the next biennium, the 23-25 biennium. And so what you see here is the forecast presented for each fiscal year by the agency, and that is the forecast that was provided to staff from GFO and fiscal. And I'll go into the process after I go to the tables of the same. But that is the agency responsible for administering that revenue source. And then you have fiscal, the fiscal analysis division's forecast for that revenue source, and then budget, or this would be GFO's forecast. And so then what you have is the last table is what we call the Technical Advisory Committee General Fund Revenue Forecast. And so what this is we'll now explain the process. So what GFO and fiscal have historically done, and continued that for this forecast cycle, which is for each one of the general fund revenue sources, all of them, but for the minor ones that the TAC is considering this afternoon, we ask each of the agencies for their forecasts for each of those 3 years. And then when that's submitted to us, GFO and fiscal have a chance to look at that and interact with each agency if we think there's questions about, to make sure we understand it. Because some of them, right, there could be a law change from the prior session, or if we see something going on. So we interact with the agency to get a comfort level with understanding their forecast in terms of what GFO and fiscal may be thinking. And so that's what you see in table 3 is that process. And so in the TAC table, we take GFO and fiscal get together and decide what we think is where the comfort is to bring forward for this body's consideration as GFO and fiscal's consensus to present to this body and for your deliberation and consideration. And so that is the information that's available. If there's no questions on the process or the tables, Mr. Chair, I can just then proceed into, and I don't plan on going through every revenue source. If those of you who've been through this process, we just mainly try and go through the ones that we think additional information should be provided to the Technical Advisory Committee members for their consideration on that revenue source.
Any questions?
Okay. Thank you very much, Mr. Chair. So this is one of those times where, if you can sort of lay the table side by side or depending on your orientation above each other, so that you can sometimes look across and see the agency fiscal budget and then look at the TAC table. And I realize it's hard for you, but I will as I go through them. So you can see the first one at the top of the table is the net proceeds of minerals and the mining gross revenue tax on gold and silver. And so for those two, you can see there's only a forecast in the table for FY23. So I need to get right out of the gate here, which is based on AB 495 from the 2021 session. This was the bill that created what you see listed there as the mining gross revenue tax, gold and silver. That is the new excise tax that's on mining operators that are in the business of extracting gold and silver. And so then they're required to annually file a return for the preceding calendar year and pay the tax on the gross revenue from their business of extracting gold and silver. The tax is set up so the first $20 million of that calendar year period is exempt. The amount over $20 million to up to $150 million is taxed at 0.75%, and anything over $150 million is taxed at 1.1%. So just to give you, that's the structure of the tax. And then the net proceeds, this is the tax that some of you have familiarity with from prior meetings, but this is a net tax. So the gold and silver excise tax, as we call it, is on gross revenue. The net proceeds of minerals tax is on the net proceeds, so it's their gross proceeds, less allowable deductions. And then it's even more complicated because the portion that belongs to the state, that there's a calculation that takes place in terms of what is the actual tax rate that they're required to pay on their net proceeds, and then what is the combined property tax rate in the tax district in which the mine is located. And so if the actual tax rate that they have to pay is higher than that combined property tax rate, that delta or difference is the state's tax rate for the general fund portion. So that's the nature of the tax. And so you can see in the table there the 3 forecasts for FY23. And then the forecast presented to you is the average of the 3 as we looked at them. That's the FY23 forecast. There is no forecast for FY24 and FY25 because under the provisions of AB 495 from the 21 session, both the proceeds from the new tax, the gold and silver excise tax, and the net proceeds of minerals beginning with FY24 are required to be deposited in the state education fund, which is the fund for the pupil-centered funding plan. So thus, that's no longer an unrestricted general fund revenue source, which by statute is what the Economic Forum is responsible for, and thus the TAC as the supporting body to the forum is responsible for. So this body and the forum no longer have to approve a forecast for the net proceeds of minerals and the gold and silver excise tax for FY24 and FY25. And so that's the information that I wanted to present on that revenue source. Mr. Chair, I didn't know if you wanted me to just go through everything or you just want to pause for those revenue sources I decide to itemize out.
I think probably taking a look at each page and just sort of pausing before we flip page to see if the members have any questions before we move on, so we're not having to go back and forth.
Okay, that works well. Thank you. So then you can see the next block under gaming-state is all the various fees or devices or licensing fees that gaming operators are required to pay to the Gaming Control Board. And that could be either as a restricted or non-restricted casino or gaming operator, as well as manufacturers, distributors, slot route operators. And so we have Mike Lawton from the Gaming Control Board is actually virtually attending. So if there are questions of the members that we think would be better addressed by the Gaming Control Board versus the staff from Fiscal or GFO, that can occur. And so generally, Mr. Lawton has a good finger on what's going on, and he's able to talk to industry and see what's going on. He shares that information with staff from GFO and the Fiscal Analysis Division so that we can have the same information set. But he prepares his forecasts, and then we look through them based on the information he provides us. And so the forecast you see here for each of these revenue sources is the Gaming Control Board's forecast prepared by Mike Lawton. And so the only observations I would add here as you look at it is you can see advanced license fee, which is GL3046, goes up to about $7.8 million in 24. Otherwise, it's pretty de minimis. And so the advanced license fee is actually a statutory requirement when generally, there are some exceptions, but that a new property is going to open, then they're required under law to pay 3 times their liability based on their first full month of business. And so the Fontainebleau is a new property that's back under construction. And based on the information set that we have, the expectation is they'll be coming on sometime like a year from now, approximately plus or minus. And so thus that would be an FY24 that they'll be opening, and thus they'll trigger the advanced license fee. And so this is the estimate based that Mr. Lawton prepared. And it's hard for us. It's not that we couldn't do an estimate, but we believe this is a reasonable amount that he has put in here for this property. You can understand the nature of trying to forecast new casinos' first full month and then the taxes due for that. And then you'll just see in FY24 for the non-restricted slots and the quarterly fee on games that compared to like the flat fees on restricted slots, that there's a little bit more growth in FY24 and then it falls back. Again, when a new casino opens and they bring on their slot machines and their table games, there's the quarterly license fees. So it can get tricky, but when they bring them on, they're required to pay the full amount due for that month. And so if it's and then they'll have to pay again at the end of the quarter for those fees. So in a sense, depending on when they open, you could get 2 full payments on those devices in that quarter, which then even those new devices in and of themselves would have the potential to drive that fiscal year's collections up. But you have the potential to get the additional payment. And so when we saw that pattern in the GCB's forecast, that made sense to us knowing that we're having a new casino opening. And so with that was the information that I thought to present to the TAC for these revenue sources tied to fees and or taxes assessed against gaming companies that are administered by the Gaming Control Board. Then, so the next revenue source, Mr. Chairman, members of the TAC, is GL 3073, Transportation Connection Excise Tax. Again, for better reference, this is the tax that was passed to pick up Uber and Lyft type operations, but it's not just applicable to Uber and Lyft. It's also other motor carriers of passengers, such as taxi cabs, buses, other motor carriers of passengers. And so this is a 3% tax on the fare. And so the reason why you see the pattern of 28 million actual, 36 million, 33 million, 39 million is the first 5 million of the biennium goes to the highway fund. So then you can see then the even numbered years will be 5 million less. So if you want to get, hey, what does it look like? Add $5 million to get to $38 million in FY24. And thus you can see that it's growing. And probably one of the things that I should put on here as forecasters that is in our minds as we're looking at some of these revenue sources is that in FY24, we know we'll have the Formula One race in November 23. We'll also have the Super Bowl in February 24. So the expectation is that those two events are going to bring people. Those people will need to get around. So they probably will be using Uber and Lyft. And as we get down to short-term car rentals, sort of the same theory or logic is applying in terms of when the forecasters were thinking about these revenue sources. So then with the cigarette tax, you can see the collections for the first 2 months, and that is a tax that is posted monthly. So we have 2 months against 2 months. It is down. And so you can see if you look across the forecasters there, they all assume that there's going to continue to be degradation in this revenue source. Sort of the basis is that, right, that this revenue source, except for tax increases, tends to go down because of the behavior by people on a per capita basis. The smoking is going down. And so that's, we think when we took this forecast as the consensus, it sort of moderates a little the growth that you see over the 3 separate forecasts and puts it, like we call, sort of in the Goldilocks place of the forecast. And so, Mr. Chairman, that was the information that I want to present on the revenues on the first page. If there's no questions, I can proceed to the next page. But if there are questions,
Thank you, Mr. Ginnon, for those explanations. That was very good. I just had a question on the cigarette tax, because in the past we've had higher declines than what we have projected. And that makes sense about what's happening in 23 and 24 with the additional. But, one thing I noticed, though, is that on this line item, we didn't use the average of the three departments. And which would have made it, I think, lower. And I was wondering why it wasn't an average of the three, and it just seemed low to me.
Thank you. That's a very good question, Ms. Walker. And so we did do the average of all 3, and so we look at sort of the permutations that you can do. And so we thought when including the agency's forecast, which you can see has the lower or the bigger declines compared to the others, and looking at year-to-date, and then when you plot it and look at how it is GFO and fiscal, felt more comfortable with taking the agency out of the averaging, just averaging fiscal and budget. Clearly, that's not to imply that the agency's forecast doesn't have more or less validity than the others. Just when we were looking at the different averages and what they look like, there was more comfortable by GFO and fiscal to bring forward what you see in the table for you. It is one of the things that will, as a forecaster, we'll get one more month of actual. Each forecaster has a chance to do forecast. So it is quite possible that we might bring a different scenario back for your consideration at the meeting later in this month.
Okay, thank you.
Any other questions, Mr. Thorley?
Thank you, Mr. Chair. This might be a question better asked or answered by Mr. Lawton than Mr. Gindin, but I'm looking at the FY22 actuals for advanced license fees, and It's more than double what the highest forecast that we have in FY24. I was just curious what properties came online that year that maybe drove that up.
Mr. Lawton, maybe it would be better if you would address that. I think I know the answer, but I think it would be better if you could. Thank you.
Can you hear me now?
Yep. Thank you, Mr. Lawton.
The advanced license fees that we had in FY22 were the result of Resorts World opening. The other contributing factor to that $16 million in collections were the Venetian, that transaction. The Sands sold the Venetian to Apollo, and that resulted in a substantial increase in collections in the advanced fees. Obviously, these types of transactions are very difficult to forecast. That's not something we were aware of when we prepared these forecasts 2 years ago. So those are the two drivers in FY22.
Thank you.
You're welcome.
Other questions? I just had one question before we go on. It's sort of a broader question, but just as we're thinking about the upcoming biennium, obviously the economy is in kind of an interesting place right now, and I would be curious to know as we go on, what, if any, sorts of business cycle impacts are affecting the projections in any of these specific revenue amounts. So I don't know that that's maybe if you could address what's on page 1 there, and then as it comes up on future pages, if there's any implications.
I can specifically talk for the staff from the Fiscal Analysis Division, and then if you want, we can have representatives from the Department of Taxation and/or the Gaming Control Board and GFO come up. But I think as we've been interacting as staff, that maybe I'll answer your question this way, and then you can tell me if all I've done is danced around your question or not. That I don't think any of us are explicitly have in our minds when we're forecasting for any of these revenue sources, or as we'll be working on the majors, that a recession will be occurring over the forecast period. We all know that the probability of such event is getting more and more statistically greater than zero, as the Federal Reserve attempting to engineer this so-called soft landing with the interest rate adjustments that they're doing to try and bring inflation back under control. But I don't think any of us are explicitly putting that there'll be a downturn in employment, and thus we may have unemployment going back up. Or that the visitors will really retract. So that's, I think, the general answer for us forecasters, is that we're not explicitly putting a turning point in the forecast to either any kind of recession scenario. Could such an event occur? Yes. And like a lot of us here are economists, so we watch the news daily as to what the Fed is doing and what's going on. And so maybe there may be a different answer to that question at the late November meeting, Mr. Chair, but right now that's the answer to your question.
Okay, thank you. We can go on to page 2.
Yes, Mr. Chair, and actually you can just skip page 2 because that's the page for the modified business tax. And so because of the 3 pieces of the modified business tax and all the various tax credit programs, it takes a whole page to be able to list the modified business tax, but that revenue source is actually handled by the Economic Forum, and thus you'll get to see the preliminary forecast for that revenue source at their meeting on November 14th. So on the 3rd page, both Table 3 and the TAC table, and again, you see the top block is the insurance premium tax as a major. So really, I think the only revenue source here, Mr. Chairman and members of the TAC, that, or the few that I wanted to address was the governmental services tax that you see the forecast there. And when you looked at the forecast for each forecaster, they're all sort of in that range, except for the budget forecast. And so that was excluded from the forecast. We're up about 2.4%. And again, this is another revenue source that it is a pretty good apples-to-apples comparison in terms of the first few months of the fiscal year compared to a year ago. Remember, this is the tax that is on when you register your vehicle. It's based on the value of the manufacturer's suggested retail price of your vehicle when it's first available for sale in the state of Nevada, times 35%. And then it's run through a depreciation schedule based on the age of the vehicle. And then it's 4% of that amount in 15 counties. Churchill and Clark have additional 1%. But the important thing here for this portion that you're looking at, it's 10% of that MSRP times 35%. That is the value to which we then attribute 10% of that on the 4% rate. So, and that's a distinction worth making because, so for a new vehicle, when it's first sold and registered, this state portion generates new revenue. It's when the vehicle is registered for the second time that it will generate revenue for the state portion. And then clearly, cars coming into the state from out of state and being registered, they'll generate revenue. So I just wanted to point that out because when you think about anybody that follows the taxable sales for autos reported by taxation, you can see during the pandemic and the heart of the pandemic and coming out of it, that taxable sales were very strong and you go, wow, that's really gonna help the GST. It does. Just new cars don't help the state's portion until they get re-registered. So it's just an important thing. So as forecasters, we have to think through that dynamic of not reacting to what we see here, but thinking a year later, as well as in-migration and out-migration of vehicles that generate this tax. So, and then the other important element to point out here is that this, under the statute, 25% of the state's portion goes to the state highway fund, to the state general fund, 75% goes to the state highway fund. So what you see here is 25%. And thus it's the 22 actual that you're looking at, the 26.4 million, that was also 25%. So just to let you know, when you're looking across it, you do have more of an apples-to-apples comparison. For those that have been through this process, this is a revenue source that would get allocated and reallocated between high fund and general fund. So sometimes it made looking at the history compared to the forecast a more difficult exercise. Here it's becoming less difficult. It's the 25%. And so with that, Mr. Chairman, that's really when I looked at these revenue sources, because with the liquor tax, OTP, which are two of the larger ones that you see there in the business license fee, again, we're not driving a recession scenario through any of the revenue sources. You can see the business license fee is expected to be relatively flat. Looking at what was going on in FY22 and in the early part of FY23 here, we think that's reasonable to be somewhat flat. And what we have to keep in mind for this business license fee, it's $500 for a corporation, and it's $200 for non-corps. And so when you look at the data, there's been a little bit of degradation in the corporation area. So if you think about it, if you lose a corporation, you need 2.5 non-corps to be standing in place revenue-wise. So then when we looked at what was going on, and the Secretary of State is able to provide information on the filings, both renewals as well as new filings. And so looking at that and looking at what the Secretary of State thought, we thought that the forecast that we have in here, and again, it's the average of the agency and the fiscals. We took the budget forecast out, given the growth that we saw in that compared to what we were seeing year to date. But again, as they'll be revisited and brought back at the next meeting. And so with that, you can see the tax credits are all compiled at the bottom, but we'll save that for the agenda item 6 after we're done. So that was the comments that I wanted to make on this table, Mr. Chairman. If there are any questions, I can attempt to answer them.
Ms. Walker?
I just wanted to compliment you because particularly the government services tax and with the whole supply demand not being able to get the chips for new cars and all this other stuff, I was really surprised how close you guys came to that. So Great job. That was difficult.
That may be the blind pig and an acorn, but okay. So,
Any other questions? All right, please go on.
so flipping to the next page, which starts with licenses at the top. So you see the 2 blocks of revenues here. And so on this one, there wasn't a lot here that jumped out as staff. Most of the revenue sources are the average of all 3 forecasters, except for insurance licenses where we excluded the budget. When you look at it, we just thought that was a little too strong a growth. And actually, this is a series that year in and year out generally keeps going up. But year to date, through the first 3 months, it's actually tracking slightly below last year. And so, but we think it's going to, probably come back a little bit because it's a series that we have several years worth of history that we chart, and you look at it and it just looks like a ladder that the years keep going up. But this year it's tracking much closer and slightly below. So thus, that was the reason for when we looked at budgets that we decided, when we looked at the average of all 3, we thought it was just maybe a little too optimistic given the information set that we have available to us at this point in time. Additionally, on the UCC fees, the budget's forecast was excluded there. When we're looking at where we are year to date, it's up some. And so when we looked at the average all 3, we thought that was pulling down. That's the scenario that we were comfortable with when budget and fiscal got together and talked through this. Again, every one of these forecasts probably has an equal chance of being right. But just as staff, we try and get to what we think we're comfortable bringing forward for this body's consideration. And then for the video service franchise fee, it's the average of agency and fiscal, but you could pick agency and fiscal, they're the same. And this is just, we got $300. The expectation is we'll get $300 probably going forward. It's not too much money that comes in on this. And we also try not to spend more than what we're forecasting as in wages when we're forecasting. So for $300, I don't think we'll get beat up too badly, whatever we put on the sheets. And so then the athletic commission fee is just one of the larger ones on this side after the Secretary of State fees. And that's the average of all 3. The staff from the athletic commission provides us their forecast as well as information that they think. This is principally driven by UFC events. It's unarmed combat. And so this is that there's primarily it's from the 8% tax that's on the receipts, the gross receipts from admissions fees to the event. And then of that, 6% comes to this revenue source for deposit in the state general fund. 2% is retained by the agency in their budget. And so with that was that block. And so given the chair direction, I'll just move on to the next block. And then when I'm done with that, we can see if there's questions on the page. Again, you look at those there's the real estate license fees. All those are the average of all 3 forecasters. And for the divorce fees, we took the agency's forecast out. It just seemed like it was a little too low. And again, not that it couldn't occur, but it just seemed the average did not leave us comfortable by leaving it in. And then the short-term car lease fee, this one I just wanted to pause on for a second. As I'd already stated, right, the sort of the story that we're trying to drive to it with this 2 big special events going to occur in FY24. And so this is the state portion is 10%. In Clark and Washoe, we actually have an additional 2%, but that doesn't belong to the state. It belongs to specific dedicated purposes in Clark and Washoe. But what's probably more important worth pointing out here is that in the 2021 session, SB 389 was passed, and some people refer to it as the Turo bill. And so it's actually called the peer-to-peer sharing. And so what this is, it really does, Turo is one of the taxpayers in this new tax. And so I don't know if you're familiar with Turo. It's like Airbnb for cars, about the best way I could say it. So people, private sector people can rent their vehicles to other people. And so the decision was made by Senator Neal to bring forward this bill to require the peer-to-peer, that they don't have to be recognized as short-term car rental companies, and thus they're like Hertz and all those be registered with DMV and subject to those rentals. But that in a sense, the person who's providing the platform to allow people to rent their car has to now collect the short-term car rental tax. So a person renting their car in every county but Clark and Washoe is required to collect the 10% tax on those rentals and remit it to the Department of Taxation. In Clark and Washoe, the additional 2% attaches there also. And so, and the intent was there to try and create some equality with regards to people who are conducting very similar situated businesses are taxed the same. And so so thus the amount of that is included in here because it's somewhat treated as a separate tax by the Department of Taxation and statutorily, but it's the same as the short-term car rental tax. But what we would run into is we can't break it out, and I can't really, you can ask me, but I can't tell you how much it is, because we would run into disclosure problems here as fiscal staff. We know what that number is because we're allowed to get it as staff, but we're required to keep it confidential. And so that's what we just want to let you know that we are taking account of the impact of that bill and including it in the short-term car rental tax, but we can't disclose those amounts to this body or anybody publicly because we would be putting taxation in jeopardy of reporting statistics that they're not allowed to, and then we would be violating our confidentiality understanding with the Department of Taxation. So I just wanted to get that out there, that that's in there. So if anybody goes and looks at it compared to like the recent history, you might go, wow, you guys are really assuming short-term car rental is coming up. And that might be counterintuitive given Uber and Lyft is probably more people are migrating to that maybe. And so it's a degradation to short-term car rental business perhaps. But now that we're picking up peer-to-peer, and so peer-to-peer it sits somewhere in the between, to me, as I try and think about it as an economist, somewhere between Uber and Lyft and Hertz, right? In terms of, somebody's not driving you around in their car, you're driving yourself around in their car, but you're getting it online in terms of arranging it. And so that's what I wanted to go to for that revenue source. And with that, Mr. Chair, I can answer any questions that the members might have on this page.
Any questions? Ms. Walker?
I'm sorry, you guys know these state revenues a lot better than I do. Going back to your discussion as far as what we have actual to date so far this fiscal year, there are a couple of line items in here that I was wondering what the difference between the first couple of months versus what we're projecting. Like, for example, under securities, so far we're up by 3.4% this first couple of months, but yet we see a decrease of 3.2%.
And that's what you don't have available to you, and that's a good point, and possibly for the next meeting, we consider that it's reported monthly by the Secretary of State, but it can have variance to what occurs in each 12 months. So yes, we're up year to date through, I believe it's the first 3 months. But when you look at the last 9 months of last year and what we'd have to do to keep, say, growing at this level, we couldn't get comfortable there. Okay. And so that's but that's a very good observation, so that maybe for some of these revenue sources, we can have in our back pocket as staff. So we'll have 2 to 4 months when we possibly come back here next time for some of the revenue sources. Well, then what was the last 8 months compared to the prior 8 months, just to give you, I think what you're asking is, you're seeing what we're up year to date. You're not getting to see what the last part of last year was up against the last part of the year before that. And that's a good point.
That's a good point, thank you. The other one was the athletic commission fees. We are down by 12% year to date, but yet we only have a 3.3% decline.
Another good observation, and that one is clearly being driven by, and we don't have the list of all the events that occur, but we do Google. That's the new researcher tool. That you could have a UFC fight in July of last year, and you didn't have a UFC fight in July or August or this year, and thus this is one of those revenue sources. We rarely read too much into the year to date because it's not like normal daily, monthly economic activity that people doing things. It's much like what Ms. Walker, we have to go through like on the live entertainment tax as a major. It's much more driven by, hey, did you have a concert this year or a big event this year versus last year? So the year-to-date stuff till you get in that 10th, 11th, and 12th month, does the comparison get easier. But out of the gate, early in the fiscal year, this is one of those that it's hard to read too much into the year-to-date.
I just want to say thank you for asking questions. Please keep doing it. 'Cause they've all been wonderful. Don't feel bad about it at all. Any other questions?
With that, Mr. Chair, I'll turn to the last page. And so the top block there, use of money and property. Sorry, I just looked down and read that. That's been there since 1994. So don't ask me why it's called that, but it is. So the bulk of that is what you see is other repayments. And so these amounts are set. And so what these are is where the legislature approves a general fund appropriation being given to an agency or agencies for a project, and then it's required, the appropriation is required to be paid back to the general fund. And generally those repayment provisions, just like a loan, they're put in law that you pay it 1/4 of it till it's paid off. And so with these, we work with the agency as well as checking stuff, the program analysts that have those accounts in GFO and the fiscal. And so these are the amounts that's set. So it's one of the easier forecasts for us to do because there's really no forecasting. The only thing that we note is that, depending on how they're structured, it can be this amount. And so there's $1 million appropriation, but they only spend $800,000 of the million. And so for some of the older programs that would affect, but generally we try and see what was the actual cost, and then you pay that back instead of, because you can see then if they have to pay the appropriation back and it costs less, then there's a true up that occurs in that last payment. That's what's going on with these, and they're fixed in. I just will note, you can see they're all 44.8, that's the GL, but each has several of them. And you can see beginning in FY 2004, there's the 446,125, 439,124. That's a new one based on a bill that was a general fund loan that was granted to a project. Then the repayments are required to begin in FY 2024. So that's why you see that getting added to the sheet there. So then with regards to interest income, GL 3290, that you see there, the numbers in that forecast. And you can see there's those that have familiarity with this revenue source, or if you go look at table 3, the table 1, you can see more of the history that the forecasts are somewhat higher than what we've traditionally seen. And so we have staff from the Treasurer's Office available in the Zoom meeting if there are questions or if they feel they want to go through it. I will go through it from staff from GFO and Fiscal's perspective to explain what the process was and the information that was being considered, and then how we got to the forecast that you see here. So as I explained at the beginning, we asked the treasurers for an interest forecast. And so they provided us a preliminary forecast so that GFO and fiscal staff could consider that. And then we had a meeting with them to discuss it and just discuss the parameters that were in play for interest. Because I'll be honest with you, GFO and fiscal have historically deferred to the treasurer's office because this is they're all sort of difficult, but this one is especially difficult. But the treasurer is the constitutional officer responsible for managing and investing the state's funds to earn interest on them. And so you can see here that we're having the forecast FY 23 and 24 and 25, but they don't even have a forecast for the general fund for 23 and 24 and 25. So implicitly as forecasters, we're having to think about that. But at least at the November 14th meeting, there'll be preliminary forecasts presented for the majors, and then both staff from the Treasurer's Office as well as staff from GNO and Fiscal will start to have some idea what maybe the general fund may look like for 23, 24, and 25. And so thus, I just wanted to get that out in the front, that this is the preliminary forecast, and as we'll look at information, there may be a different forecast or not brought back to this body for the next meeting. And what I would point out is that the things that the Treasurer's Office staff, as well as GFO and Fiscal, had to take into consideration and discuss to see that we had the same understanding is clearly the most obvious one is the interest rate scenario. We have the Federal Reserve significantly raising rates. What's that doing? That's raising short-term rates. Well, the Treasurer has to maintain a certain amount of liquidity in their investment portfolio because, right, this is money coming into all the different funds, not just the general fund. There's the highway fund. There's other funds. But there's also checks being written against those funds, right? So they're trying to look at what's coming in as the amount that they can go invest, both short-term or maybe more than a little longer term. But with the feds raising the short-term interest rate, then clearly that part of the yield curve is shifting up, as well as the intermediate to longer rates are shifting up somewhat also. So that's one of the big factors, that what you can potentially earn now for a dollar invested versus what we could earn prior to the Fed taking the actions that it was, and to try and check inflation. On the other side of the mathematics is that we have things on the funds that are available to be invested and earn interest, such as we have the American Recovery Plan Act, ARPA funds, that the federal stimulus funds. And so those have been provided to the state, and as the state is getting those allocated and spent, but they're able to sit there. And under the guidance by the U.S. Treasury and federal law, the interest that's earned on that is deposited in this GL. And also, you probably heard at the October meeting of the Economic Forum that the actual collections for FY 2022 were $1 billion over the forecast. So if you think about that, that is money that really doesn't have an appropriation tied to it, because the budget was built on the $4.5 billion revenue estimate, and we collected 5.5, and so the appropriations were down there. For FY23, the general fund forecast from May 21 was 4.7 billion. Well, if we were at 5.5, we'd have to have quite a bit of degradation to get back to 4.7. So I think, right, we're going to continue to see actuals come in. So that's additional money that's in play for the treasurer and as the forecasters to be thinking about in this forecasting exercise. And so clearly it can have an impact on FY 2022. All that should be beneficial to FY 2023. And even some of this actual over the forecast or over budget amounts, it will get transferred to the rainy day fund, either through the statutory provisions requiring 1% of the economic forum forecast to be transferred, or 40% anything over a 7% ending fund balance has to be transferred. So clearly, the governor can recommend and the legislature can approve some of this money could be allocated during the 23 session to be allocated in 23, but 24. And so the expectation would be is that some of this excess that we're talking about now will be spent down over the next biennium. The ARPA money will be spent down over the next biennium compared to the levels that we have now. So as staff from GFO and Fiscal and the Treasurer's Office have been interacting over this week on those elements and working through it, out of that, all that information and what I presented to you is the forecast that the Treasurer's Office provided to us, and GFO and Fiscal looking at it, giving the information set that's available to all of us, and again saying that we're still sort of guessing at what the general fund could be for over the next biennium. GFO and Fiscal were comfortable bringing forward this as the consensus, as the Treasurer's preliminary forecast here. And because it sort of has the pattern that GFO and Fiscal were thinking about, and especially as we were interacting and discussing with the Treasurer staff, this information set and thinking about the higher, because also, right, the feds are probably going to start backing off interest rates, we hope, if they can get inflation curb. So that's what you have here is interest rates higher, the amount of money that you have higher, and that's going to benefit 23, probably benefit into FY24. But if they start to bring rates down and then we're spending the ARPA money and we're spending some of the excess, then you should see 25 coming back down compared to 24. And so when we looked at this, that we were comfortable. And so clearly things are fairly dynamic here, and we will, as staff from GFO and Fiscal, continue to interact with the Treasurer's Office once after the November 14th meeting, because we might have some idea where the revenues could be min-max or average and or where things may be interest rate wise and or economically. So with that, that was the information that I wanted to present. And again, we do have staff from the Treasurer's Office. If they feel that they want to put anything on the record and or if there's questions from the members, then they may be better addressed by staff from the Treasurer's Office. And hopefully I didn't misstate anything from the Treasurer's Office perspective as we've been working this week to work to this sort of always complicated, but even more complicated right now given the current context and environment. And so with that revenue source, I'll just go through, I'll continue, Mr. Chair. Expired slot machine wagering vouchers at the top of the next page under the missed sales and refunds. This is the revenue source where it's, we sometimes refer to them as TITO, ticket in, ticket out, for your gaming devices. And so, right, when you cash out, if you don't redeem that voucher, then after 180 days, it's deemed expired. And then 75% of the value of that is required to be remitted by the gaming licensee to the Gaming Control Board to be deposited in the State General Fund in this GL. And so if you go look at the table 1 and you can see, wow, this is, you've got, it went up in 22 and you've got it forecasting up. Well, you can see year to date, we've got about 9.7 million. This is remitted quarterly. And so that 9.7 is 2 quarters. So the expectation is we probably should be in that $18 million range or thereabouts. So when the Gaming Control Board provided these forecasts to GFO and Fiscal, we were comfortable with them. Talking, again, us thinking through it, but also then talking with Mr. Lawton. Sort of the reasons lying behind this are that why we saw the increase 22. Well, if any of you go look at the charts that we put together for the economic forum that are available on the Nevada Legislature's website for the forum, and look at the gaming charts, the slot win is very big in terms of what we've been seeing. And so clearly that means there's more slot play. So is there an expectation that there might be more unredeemed slot vouchers in proportion, right? That because as the slot win goes up, that means people are playing more. And remember, the slot win that I'm talking about is from the casino's perspective, not the patron's perspective. But you have more activity on that. Also, there's an interesting phenomena that sort of pandemic related that there's a coin shortage. And so some of the properties actually, if you win $3.37, you go to the machine, they'll pay you $3, but they'll leave the 37 cents on the voucher and you need to go to the cage to get your 37 cents. So I think as economists, or you don't even have to be an economist to go, perhaps the opportunity cost of walking to the cage to get your 37 cents is bigger than the 37 cents. So some of these tickets end up getting unredeemed. So that's what's driving this, and we think the expectation is that it's perfectly reasonable to expect that it would stay up in this range over the forecast horizon, given what we're seeing going on and expect to probably go on throughout the forecast horizon. And then finally on this page, the unclaimed property, because we also have, I think, staff from the Treasurer's Office here for the unclaimed property if there are questions. But this is, it's sort of like the expired slot machine wagering vouchers, but they're the different types of property, and they have under the NRS different time periods for which they are deemed to be unclaimed. And they're a longer horizon than this 180 days for expired slot. But so we have the ability to go in, and the controller, the state treasurer, when they're putting information in a controller system, we can see the different components of this and what's getting posted and look at that. So both GFO and fiscal have that information, the forecast, and clearly the treasurer has that as well as additional information. So you can see the three forecasts in table 3 that are presented to you. And fiscal is and the budget are a little higher in the first year than that. But when we looked at the average of all of them, we're going, okay, that's sort of like trying to split the baby. And again, this is a tough one because it's a net. It's people are required to turn unclaimed property over to the treasurer's office, but it's a perpetual claim against the state. So then you can go out and find your stuff and claim it. So what this is at the end of the fiscal year, the net that's there from the inflows and the outflows is transferred. So that's really what we're forecasting here, is that net of what you think is going to come in and what you think is going to go out. And that's sort of what you see here. And then as you get out into 24 and 25, the variance is much less across the three forecasts. But when we looked at the average of all of them for all 3 years, we thought even the first year, that 47 puts you sort of what we may call the slot. It's somewhere in between there. And so, Mr. Chair, that was the information I wanted to present on the revenues on this page. And with that, I can answer any questions. And again, if there are any questions on interest or unclaimed property, that would be better addressed by staff from the Treasurer's Office. I believe that they are available to us in the Zoom meeting.
Okay, Ms. Walker?
Thank you, Mr. Chairman. Just on the treasurer and the unclaimed property, we don't have any year-to-date figures. Can we get that? And if not now, maybe at the next meeting?
So the first quarter interest distribution we may have by the end of November meeting.
Okay.
Because it's a quarterly distribution that the treasurer does, and I realize the quarter ends in September, but there's the calculation that the treasurer has to do the interest allocation earned on the pool to all the different, and that just hasn't been posted to the controller system. But it's generally, can be in this November period.
Okay.
It just wasn't before this meeting. So we will, the Treasurer's Office staff is hearing it here, and we can see that if it hasn't been officially calculated and posted, if there's at least a preliminary number that they can provide to us, that will help. But I'll be honest with you, Ms. Walker, it'll help us see the first quarter, but it may not help us much for the future because of what I discussed about the interest rates going up and all this money. But we can attempt to get that. On unclaimed property, again, we'll talk to the Treasurer's Office about what we can bring forward here and present publicly, because there is information getting posted in the controller system on both the inflows and the outflows, and we're able to see that in the controller system. It's in flux because there are postings daily. And so I would just reserve the right to have a conversation with staff in the Treasurer's Office about the pros and cons of bringing that information forward to this body to help explain the forecast.
Okay.
But it is a valid request, and we will just, as staff, discuss it with the Treasurer's Office.
Thank you very much.
Mr. Thorley?
Thank you, Mr. Chair. Mr. Gindin, up on the general fund repayment section, so last legislative session in 2021, there was a $50 million loan from the general fund made to the K-12 education stabilization account, which is like a rainy day fund for K-12 education. Now, there wasn't any set repayment schedule for that. It was would be repaid to the general fund based off of transfers from the state education fund to the K-12 education stabilization account. So is that why it's not on here as a forecast? Because
That's my understanding, that it's not processed like this type of repayment. If that's not true, then we would have to pick that up. But the way we were looking at it in the information set that we had, that it's required. There's provisions with regards to it requiring to be repaid. But I'm trying to go from memory here. The structure of it is different than we see for these types of repayments that I'm talking about here. So it's a valid thing that we'll have to take into consideration and that staff from GFO and fiscal can look into. Because we were aware of it, but our thinking was it's just not here. It'll be handled off the unrestricted general fund revenue tables. But if that's an incorrect assumption, then we'll bring that adjustment back for the next meeting.
I think you're right, Mr. Ginden, that it's different than these where there's not a set repayment schedule. It's based off of excess revenue collected in the state education fund. So that makes sense to me. I just wanted to confirm that. So.
No, it's a good question, and we will circle back with our GFO colleagues and just to make sure that both offices are on the same page as to how to interpret those statutory provisions as they exist and whether or not they should be placed on the repayment schedule that we see here for unrestricted general fund revenue.
Other questions? I had just one question. I think it might be better answered by Mr. Lawton. But thinking about the expired slot machine wagering vouchers and the increase in slot play, my understanding is from prior conversations that like the virtual table games, like roulette or other table-like games that are actually automated and not run with an actual person at the table, are classified under slot machines instead of different types of revenue, and just wondering if, just confirming that that's true and if that might be having an impact on some of the increases in slot play that we're seeing, especially since that number is carried forward into fiscal years 24 and 25.
For the record, Mike Lawton, Nevada Gaming Control Board. Great question. We haven't really seen a huge shift from a table games count into a increased number of slot devices. They've both been relatively flat. I know there is a goal of, having customers, the price point is too high at some certain types of table games, so customers will feel more comfortable, less intimidated by playing these electronic versions of table games, which you are correct, are considered slot machines because the types I think that you're referring to do not have a live dealer and a random number generator determines the outcome. So it is a slot machine. So the reason why maybe slot win is outperforming table games win, and don't get me wrong, table games win is performing outstanding as well. There's a huge international baccarat component that's still kind of not there. It's there, but it's not like maybe it used to be 4 or 5 years ago. So that's why the slot revenue is setting these all-time records, whereas table games is lagging a little bit, although performing at record levels as well. I don't think it's really necessarily because of this shift from table games into these electronic table games. Unfortunately, we don't get data on if the game or the slot machine is an electronic table game. We get information based on whether it's a nickel, a penny, multi-denom, 25 cents. So, but our slot counts haven't risen and table games decreased where there might be some kind of seismic shift on a casino floor. There are more of them. But I don't know that that's necessarily the reason why slot win is off the charts like it is. There's a lot of other reasons why. I don't know that I could really pin it on that scenario. I hope that helps.
Yes, thank you.
Mr. Chair, your question sort of reminded an element that I should probably just add since you asked about expired slot machine wagering vouchers, and we may have to actually change the titling here. There was a bill passed last session that was brought forward by the Gaming Control Board to sort of change the statutory definition of these expired wagering vouchers, so to sort of lose the slot machine construct and to add digital representations, which is actually a hard concept for me. It's one thing to throw a piece of paper on the ground, but I don't know how you lose a digital representation of a voucher, but I guess it can happen. So thus the law was amended, and it was our understanding as the Gaming Control Board was testifying on that bill that there is interest within the industry to, like many things, to move away from the paper construct and move into a digital. And so that it's our understanding from talking with Mr. Lawton that probably hasn't become a big part of the market yet. But it is one of the things that we would have to keep in mind if it does, because if you move away from the paper to the digital, my null hypothesis would be that it would be a degradation to the number of expired vouchers, because I would hope a person maybe could set a reminder in their phone to cash that in before it expires. But you could see where it happens, that somebody leaves it on, and they leave Vegas and they don't come back, and, you know. And so that will be the whole thing is, you got to be here to cash it in, or you can cash it in digitally and all that. So your question made me realize that there was a piece of legislation to sort of move it away from a pure slot machine construct to a digital construct. And so even that if they wanted to start doing the vouchers at table games and then using the digital construct, then the statutory construct would encompass that.
Thank you.
And Russ, I think, to your point, the two driving factors why this tax is where it is slot revenue, and then the change in customer behavior with the lack of change was a real eye opener for us, and we had to make some phone calls to, verify, that's indeed the case. There's a coin shortage. I don't know if you guys were aware of it, but these casinos can't order enough change. They're limited by the amount of change that they can order to fill their banks, and so they'll fill the change bank at the casino cage, but they won't be able to fill all the impressed banks at these kiosks where customers go and exchange these vouchers. So it's a change in consumer behavior as well. Yeah, there are vouchers for sports books and table games that don't get cashed, but those are the two reasons why this tax is where it is, or this collection piece is growing like it is.
Mr. Chair, if there's no other questions here, then staff, I'll conclude that we're probably done with agenda item 5 and then can move on to agenda item 6, which is the tax credits.
Yes, please.
Okay. Thank you. So at the bottom of the last page there, you see it several times, and it's not because we want to keep showing you tax credits. It's just that's how we have to set up the tables to account for them. And so I'm not going to spend a lot of time on this. You can see if there's questions to answer. So these are the tax credit programs that are in play. So the film transferable tax credits, a staff from the film office actually provides us, again, a forecast for the credits. And they're able to tell us the projects that have applied, been approved, and they're actually, the audit's done and they've been issued credits, and the credits have been taken, or the credits have been issued but they haven't been taken, or what we call is there's projects that have applied and they're in the process of maybe getting approved, or they have been approved and been approved for a certain amount of tax credits, but you don't actually get issued an amount of tax credits until the audit's done. So you could get approved for, say, $3 million, but only get awarded $2 million, because it's based on what you're doing in terms of your expenditures, as well as the wages paid to employees above the line, below the line, and all that. But this is the forecast based on information that was provided to us by the film office. And so we were comfortable based on that information as a forecast of what could be taken. But again, because of the nature of this one, having to get approved, the timing, and it's all, I know more about this than I ever thought I would, about key grips and all that kind of stuff, but that you have pre-production and post-production and shooting and scouting and all that kind of stuff that has to occur while they're doing the productions. And right, they could even come into Nevada, shoot portions of it here, shoot portions other way, then go to Hollywood and put it all together and cut it and edit it and all that. So that's that forecast. Then the economic development transferable tax credits. The line is just there at 0. These were the ones that were for the Tesla Panasonic Gigafactory project. And we sort of have to leave them on there because to the left of this are hidden columns with that in it. So if we can hide the row, but we leave it on there to remind ourselves, don't delete the row. And then the catalyst account transferable tax credits. This is the one where there is an amount authorized in statute to which they can issue credits for economic development type projects. And this, based on the information from the Governor's Office of Economic Development. It's a program that's just not getting used. It has, I believe, around $5 million a year in tax credits that now are available to be used and granted. And so based on that information, we're forecasting zero. The Nevada New Markets Jobs Act tax credits. This is the program that if you would go look at the history, you'll see it was there. This is the second iteration of this program that was approved. And so the way it works is insurance companies can make $200 million worth of contributions to qualified economic development entities. And then they go out and try and invest that. But so then the insurance companies can get a 58% credit against their contribution. So 200 million times 58% is $160 million. But the way it actually works out is you start taking them 2 years after you make the contribution. And so, but it was effective for them to take it beginning with FY 2022. And it goes 12%, 12%, 12%, 11%, 11% to get to the 58%. And so you can see 12% of 200 million is pretty close to 24 million. And by gosh, we were pretty close to 24 million. So thus we believe this is, and then the correct amounts is to put the full 12%, 12%, and then 11% on the sheets. It can start to vary a little because of the timing, but you can see it was pretty close to 24 million in FY22. So we think we're not going to get beat up. Then the education choice scholarship tax credits. Those amounts there are us thinking through it and then getting information from the Department of Taxation. This is the one that there were statutory changes made to the program in 2019 to take the 10% escalator off and cap the amount off at 6.655 million. But also in that session, they added an additional $4.745 million for 2 years. And then they came in last session in AB 495 and added 4.745 for the 1 year again only. So the 6.655 and 4.745 is this 11.4 million. But the thing we had to think through is that the 6.655 million, if the total amount is not awarded within the fiscal year, then they're gone. So if you would only do 5 million of the 6.65, you can't carry the additional. But of the 4.745, they don't. They can be carried forward. So thus we had and clearly the pandemic, but distortions and everything, including this tax credit program in terms of people making contributions and then getting the tax credits. And so, for the education choice. And so we're looking at it, we think it's safe to, you got basically the 11.4 million finally in FY 2022, and with the 4.745 that's still out there from the last two editions, that we'll see that show up in FY 23 and FY 24 because it can be carried forward and stacked on top of the 6.655. And then we go back down to the 6.655 in FY 25 because we'll be through those three 4.745 allotments. And then the college saving plan, you can see the actual amount and thus the forecasts that are there. And the Affordable Housing Tax Credit Program, this is the program that was approved in 2019 as a $40 million 4-year pilot program with $10 million a year authorized, but they can do $3 million more if needed to make a project pencil out. In 2021, the sunset was taken off, but the $40 million was left in place. Thus, the housing division can use till they exhaust the $40 million. There's no sunset. And so this information was provided to us by staff from the housing division. And so the 13 million is actually 3 million that they approved from the 10 million the year before. And so then the 10 million is what they think they'll be able to get out the door. Being able to bundle it with other federal programs and the federal stimulus programs in terms, and then similarly for 24 and 25. And so based on that, and we think since this is still somewhat of a new program, and with what the housing division is telling us with the affordable housing need, and being able to bundle our state tax credit program with federal programs, that it's probably prudent to put the full amount of the tax credits on for each of the 3 years while we're still learning about this program. And so with that, Mr. Chair, those were the statements I wanted to make with regards to tax credit programs. And so that would conclude my testimony under agenda item 6.
Any questions on the tax credits? Ms. Walker?
Russell, just, so on the affordable housing transferable tax credits, there was 0 in 21, 0 in 22. It was available, but they just didn't take advantage of it, or it was a new program and it needed startup time, or?
Sort of the answer would be yes to everything that you just said. Because it was passed in 2019, it was a new program, so the Housing Division had to get the implementation of it. Then, we had the pandemic. So it was our understanding that, yeah, they were sort of getting things lined up, and then, that sort of, evaporated a little bit, and then they got it back. So, but also this, under the law coming out of 2019, the credits were more on the back end, which is that you had to do your project, and it's a process that you have to go through. And the Housing Division staff, if you ever want to know, they do a great job of explaining this. And so I won't attempt it. But it's like many things. You have to apply, and then you have to get approved, and you're trying to get your federal stuff, your state stuff, and your own financing deals to get the affordable housing, get the approval to build it, and the permitting and all that. So there can take that time. But then the credits would have been on the back end of the project. Mm-hmm. But what they realized is when they were out there trying to work this program in the real world, that made it difficult because, there's the present discounted value of $1. So then in the 2021 session, working with Senator Ratty, who was the original sponsor of the 2019 bill, we moved the state tax credits up to more to the front end of the process, which then the Housing Division believes that makes them much more viable to be able to get out there and work with the other programs to make projects pencil out and then get them breaking ground and going. So that's really the answer to your question, that it was yes to all the points that you made about implementing a new program and then having a pandemic and then realizing that we needed to make some adjustments to the program to actually make it more viable for the agency to be able to administer in the real world.
Any other questions? Okay, I think with that, we're ready for a motion to approve the revenue forecasts and tax credits for agenda items 5 and 6.
Mr. Chair, I'd make that motion.
Okay, do we have a second?
I second.
Okay, we have a motion from Mr. Thorley and a second from Ms. Walker. Any further discussion?
From her.
Oh.
I was
Oh.
going in when she did it, so she's first.
Okay. Well, thank you very much. All in favor, please say aye.
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 Any opposed? Okay, motion passes unanimously.
Mr. Chairman, if you don't mind, just before you proceed to public comment and then adjournment, I just thought I have a few numbers here that might be of interest too. So, because when you're looking at this for the FY22 actual, you have all the revenue sources there. So just for consideration, the actual amount for the revenue sources listed in this table was about $887.9 million. So if you take that and you add it to the $930.8 million, which is the forecast shown in the tables for these, then that's about $1.818 billion. And so that's about $149.5 million less than what you see as the forecast for 24 and 25, the bottom line total general fund after credits. But then what we need to keep in mind is, the MPM and the gold and silver are coming off the sheets, which is, if you look up above, it's probably around $150 million a year or $300 million. So if you back that out, everything excluding MPM and gold and silver, the 23-25 biennium forecast, that is the forecast for FY24 and 25 here, compared to the actual for FY22 and the forecast that you approved for FY23, it would have been about $105.7 million higher. So I just wanted to get that out there, and also if any of the people in the press are listening, that they go look at this and go, the miners are going down. Well, they are, but it's not because of the forecasting per se, it's because there's a law requirement that $300 million over the biennium is required to come off of these sheets and go over to another set of sheets. So, Mr. Chair, I just wanted to get that information out there in terms of, and for your consideration also for the body.
All right, thank you. With that, we can go to agenda item 7, which is one more opportunity for public comment. Do we have any public comment here in Carson City? Do we have any public comment on the phone? Okay, can we have someone from broadcast just confirm there's no one on the phone wanting to make any public comment?
Hi, Chair. There is no public comment, or sorry, there are no public on the phone to offer public comment at this time.
All right, thank you very much. With that,
One second, if
Yes,
you don't
yes.
mind. Sorry, we don't have schedule. I might have to have you slap the gavel down on my hand, so it didn't make a noise. So we're, as you know, we've been interacting with you, and we're tentatively looking at November 29th is probably the date. As you realize, this is going to be a pretty tight turnaround with the forum meeting on November 14th, and so we'll see you shortly again, the way days go by. So we will be getting additional information as we've discussed, and then as necessary, interacting with state agencies or constitutional officers and their staff, and bring back, as necessary, a revised forecast for your consideration at that next meeting. And staff will just be working with you in terms of the schedules. But I think we're just logistically, Thanksgiving always causes a problem, but we think that's the date that's probably most viable, Mr. Chair, to have the meeting. And again, some of the comments and questions that are here, we'll give consideration to in terms of what we can bring as additional information back. And so I just wanted to get that out there here in the meeting on the record as to where we're at. And so if any of the members do have things that come up, please let us know as staff. We can attempt to try and entertain those, and then, if, as necessary, handle them at the next meeting. And we'll clearly work with Chair Schmidt on setting up the meeting, the agenda, and all that stuff that we do as staff working with the chair.
all right. Thank you very much. And with that, I believe we are adjourned.